So in this video, we are going to talk about the differences between Medicare supplements F, G, and N. We always recommend a plan G, and most of the time, your clients are going to be like, okay, he wants plan G, says plan G, we're going to take plan G, but you are going to have that guy that says, okay, but why? My grandpa had plan F. I'm just going to have plan F. I want plan N, plan G. Sit down, take the time to explore each one with your clients and explain to them why you recommend a plan G. So first, Matt, tell us about plan F,
okay.
What it covers and why it's not necessarily a good choice anymore.
Awesome. So plan F used to be the plan back in the day that everybody went to. All of
the old Cadillac plan.
Exactly. Everybody went on plan F. If you were selling a Medicare supplement, if you were going on Medicare, whatever, you were taking a Medicare supplement plan F. Didn't matter the company, but you were taking a Medicare supplement plan F. The reason being is because if you pull up a chart of all the different Medicare supplement plans and look down, there's some great visuals if you Google it, but it'll show plan F covers everything. 100%. If you're looking at the chart online, it's got little green checks in every single box. It covers everything. Your client takes it out, pays the premium, pays their plan, their Part B premium, pays their Medicare supplement plan F premium. They didn't pay anything else. They go to any hospital or doctor in the country and do so without being referred. Never spent a dime on anything. So Plan F was a fantastic plan. We loved Plan F. Everybody loved Plan F. The reason why Plan F's not really a good plan anymore is because the MACRA laws were passed. I think in 2015 they passed MACRA, M-A-C-R-A, if you want to do some more Googling. But MACRA, what it did was it did away with plans that covered the Part B deductible, which would be Plan F. So since what it did was it maybe that probably wasn't a good explanation. It didn't do away with those plans. It basically closed the door for any new Medicare beneficiaries, is probably a better way to put it. And so what it did was any new Medicare beneficiary, a new Medicare beneficiary is defined as somebody with their Medicare effective 1/1/20 or after. So anybody that's got a Medicare effective date of 1/1/20 or after, they're not eligible for Plan F. Now, anybody that's got 12/1/19 or prior can still take out a Plan F, but it's just any new Medicare beneficiaries, so anybody going forward is not eligible to take Plan F. Now, a lot of times clients will ask us, or people, agents, whoever will ask us, well, they're still eligible for F. They could still take Plan F, right? You could, theoretically, they could take Plan F. It's just not a good idea. Why Plan F really may not be a great plan is we do, here at Secure, we do a lot of Medicare seminars. And so we talk to rooms of 40, 50 people about Medicare supplements. And so one thing that we like to say is to the group of people, hey, all right, everybody in this room, can we agree on something? Can we say that 65-year-olds are typically more healthy than 70-year-olds, right? And 70-year-olds are typically more healthy than 75-year-olds. 75-year-olds typically are more healthy than 80-year-olds. And you can make the case that it continues to go up, that younger people are typically more healthy. So what the example we like to give to the room at seminars is okay, if we leave this door open over here and we continue letting 65-year-olds come in, what's it going to do? It's going to cause our age to be lower. It's going to help with the claims and offset those higher claims. What happens when we close the door, right? We close that door and don't let any more 65-year-olds in, which is essentially what the MACRA laws did. No more 65-year-olds can come in. So we're keeping all the 65-year-olds out, and everybody in the room here is just getting older. And what did we just say? The people that are older typically are less healthy. What happens when you're less healthy? You have higher claims. What happens when you have higher claims? Well, premiums go up. And so the reason we typically don't recommend Plan F if a client's eligible for Plan G or something like that is because you're just paying more money. G is typically a lot cheaper. I'll let you explain G here in a second, and it'll make total sense why you would rather take Plan G for the lesser premium and pretty equal coverage. So Dallas, if you want to talk to us about what Plan G is and maybe kind of answer that question that we posed, why it makes more sense to take F than G.
So like he said, with a Plan F, you have zero liability out of pocket. You pay your Part B premium, you pay your Medicare supplement plan premium, and then you pay nothing else. So you think, well, that sounds like a great deal, right? I don't have to worry about anything. Well, here's the deal. There is one difference and one difference only between F and G. and that is the Part B deductible. We always have a graph that shows from CMS saying, okay, here's what an F covers, here's what a G covers, and there's, like I said, only one little checked box there that is not checked. That's the Part B deductible. So a Part B deductible on a plan on a Medicare supplement is $203. So what we can do to show your client is show them, okay, here's the premium for a Plan F. Here's the premium for a Plan G. And every time, and if you come across a time that it's not like this, I want you to send it to me and I'll show you how you did your math wrong, okay? But every time, typically, the Medicare Plan F will cost anywhere from $40 to $60 a month more than a Plan G. So what I do with my client is, okay, let's do some Medicare math. This plan over here costs you $50 more for a Plan F. And I'll say, yeah, but I don't have to pay anything out of pocket. Over here, I got to pay that Part G deductible, or that Part B deductible. So I say, okay, let's look at this. If you take 50 times 12, that's $600, right?
Good thing you knew I didn't have 600 fingers and toes.
I was panicking for a minute, a little bit of, but so that's $600 that you have to pay out of pocket to have the Plan F over the Plan G. Now, again, what's the difference between the two? The Part B deductible. How much is the Part B deductible? $203. And if you really want to become a smart aleck, you can say, okay, let's play a game. You give me $600, I'll give you $203. My only question is, how many times do you want to play?
We played that game earlier. It only took me one time to realize I didn't want to play anymore.
Yep. So I'll get him later again. But that's why a Plan G makes more financial sense than a Plan F. Yeah, they have to pay that $203 the first time they go to the doctor, but it's going to save them $400 over the course of the year.
Well, and it's crazy because that's probably on somebody that's turning 65. If you think about it, somebody that's 70, 72, 75,
it's going to get up into the $100, $150 range. And
Easily
you're going to be their hero.
that.
Yeah. So
after the Part B deductible, paying that, you're still saving people $1,000 or whatever.
Yeah, exactly. And now, don't get me wrong, it's tough. If you run across somebody that's got a Plan F and they're 72 years old and they've had a Plan F for the last 7 years, they like it. And it's hard. And I've walked away from a house before and I could have saved them $2,000. And they're like, nope, I like my Plan F. I go to the doctor, I slap the card down, and after, I mean, you can show them all the Medicare math you want. Nope, I like my Plan F. So it can be difficult sometimes, but that's why
most people are pretty receptive.
They are. We're in that
once you see the.
So it's, sometimes you can even show me, and it still ain't going to help.
Right.
But we like a Plan G over a Plan F, and that's why it makes a lot more financial sense. And Plan F, like Matt said, is just going to keep going up and up and up and up and up, while a Plan G is going to go up, but it's not going to go up as quickly.
We're seeing increases typically. Again, we're in Missouri in the single digits on G.
Yeah.
Typically, you're looking at 15%
on
F, 12 to 15. So it does take much higher increases.
Right. The other one, of course, that people come across is Plan N, and we will still sell a Plan N
here and there.
Here and there, we probably sold 10 or 15 of them last year. But I will say this: if somebody walks in, they say, "Look, my neighbor has a Plan N. I want a Plan N." I'll tell them, "Look, here's what a Plan G covers, and here's why I recommend a Plan G." But if they still want a Plan N, if somebody wants apples and they walk in and they want apples, don't try to sell them bananas, right? So Matt's going to explain now the difference between an N and a G.
So Plan N is a good plan. We don't sell a lot of it here at SIG because there's a few things that it does that we really don't like. Now, we think that G is more of a comprehensive, better plan, and so that's what we sell. Plan N, the only things that it really doesn't cover, the only two things that we don't like about it is number one, your clients could have copays. So there could be copays on some things like emergency room and primary care doctor copays, which in my opinion, if I'm paying a high monthly premium, I don't really want to get nickel and dimed on the copays. That's not my huge issue with it though. I could get over that, right? The big thing is, Dallas, it doesn't cover the Part B excess charges.
What's Part B excess charges?
That's a great question, Dallas. So what is a Part B excess charge? So a Part B excess charge, I'll break it down for you. So basically Medicare has, I always tell clients it's a big book, right? They've got a list of all the Medicare assignments, probably not a book, but they do have a list of all the Medicare assignments. And so a Medicare assignment is basically the maximum Medicare allowable charge that they'll let the doctor charge for a service. And so, for example, if I was going to go in and get my knee replaced, Medicare may say, for simple math, Medicare may say the maximum that you can charge is $10,000 for that knee replacement surgery, right? That's the maximum Medicare allowable charge. Okay, well, Medicare, or excuse me, the doctor has a choice. He can say, number one, okay, I accept Medicare and I accept Medicare assignments. So what he's saying there is I accept that $10,000. We're good. I'm going to call it good. Doctor number two can say, hey, I accept Medicare assignments, but I don't accept Medicare, or excuse me, I accept Medicare, but I don't accept Medicare assignments. And so what Medicare does is they allow that doctor to bill 15% more above the maximum Medicare approved amount, which is the Medicare assignment. And so, for example, that knee replacement, if that doctor bills 15% more, it's now $11,500.
Hold on. You're right.
Okay, good. So that's now $11,500. So how does that work with a plan in, right? Well, they're going to bill your Medicare or they're going to bill Medicare 80%. They're going to bill your supplement the other 20%. But who's out the extra 15%? That extra $1,500?
Bob and Mary.
It's not the insurance company. It's not Medicare. It's Bob and Mary. And so that's why we
really
don't
just
really
Bob. It's not Mary's Bob.
Really, that's not why we're a big fan of Plan In. It's just there's holes in it, right? Like I said, we're really not worried about the copays, but those excess charges, man, those could add up. You know, on $10,000, that's a lot of money. But what about $100,000 or $1 million? It just continues to add up, and those are scary numbers. Fun fact: MD Anderson, you know, the famous cancer hospital, actually does not accept Medicare assignments. They charge excess charges.
Yeah,
you can call them and ask them. If your client is on Plan In and goes to MD Anderson for cancer treatments, they're going to be calling you pretty upset.
Yeah.
So don't let them do it. So that's why we prefer Plan G over Plan F or Plan N. So we really think G is where you want to be. It's a product that you want to sell if you're selling a Medicare supplement. If you have any other questions, I don't know if you got anything to wrap up. If you got any questions, call us. We're happy to explain it.
I just thought of something. Here's something too, and I'm sure our agents already know this, but the thing about it is, a Plan G is a Plan G is a Plan G. CMS actually writes what is in a Plan G, the Center for Medicare and Medicaid Services. And I always tell my clients, it's kind of like this, right? I like to use pictures. It's kind of like Coca-Cola. Coca-Cola bottles their product at their factory. They then send it out here. We've got Hy-Vee, Walmart, Price Cutter. They send it out to all the different stores, right? And Hy-Vee can determine if they want to sell their product. They can determine where they want to put it in their store and how much they want to charge. That's it, right? They cannot open it up and say, you know, we like our Coke with a little more sugar, or we were going to take out some of it, or whatever. They can't do that. There's laws that say you can't open that container.
So it's the same Coke.
Yeah, it's the same Coke no matter where you go. So I always tell my clients, if I'm sitting there and they've got a Plan G, but I can offer them a Plan G for $28 a month less, that would be like walking into Walmart or Price Cutter and say, well, Walmart has a 2-liter of Coke for, I haven't bought a 2-liter of Coke in a long time, a 2-liter of Coke for $3.28, but Hy-Vee has it on special for $1.99. I'm going to get it at Hy-Vee every time because it's the same exact thing. It's the same with supplements. A company, all the different companies out there can determine which ones they want to sell, where they want to push them. Like, for example, they have niches. Their Plan G here in Springfield may be less than even St. Louis, and then how much they want to charge. And so I tell my clients, there is no difference. A Plan G is a Plan G is a Plan G is a Plan G. So make sure your clients know that every year they need to be watching that. And if they can health qualify and they can move, or if you're in the great state of Missouri and there's an open enrollment period, move them if you can save them some money, right?
Awesome. Well, hey, we hope you learned a lot. If you have any questions, call our office. Dallas and I are happy to answer any questions anytime.
We're here now.
Yeah. So have a great day, everybody.